If you had invested in the BSE 500 15 years ago, you would have earned a return of 11% per annum. That's quite good for a market index. However, instead of the BSE 500, if you had invested in healthcare, auto, and IT back then, you could have done even better. Your returns would have been about 14%, 13%, and over 12% respectively. Now, what explains this difference? Well, 15 years ago, healthcare, auto, and IT were emerging and high growth sectors. Investing in such sectors or industries is rewarding as you already enjoy favorable tailwinds. But that was the case 15 years ago. What are the high growth pockets now that you should keep on your radar? Hello and welcome to ET Money's YouTube channel. In this video, we will introduce you to 3 emerging industries with high growth potential. Investing in these can mean superlative returns for your portfolio, so do watch this video until the end. But before I start, there is something important you should be made aware of. We have encountered fake accounts and groups impersonating ET Money on WhatsApp, Twitter, and other social media platforms to mislead people. You can see a few screenshots of these fake groups on your screen right now. If you ever come across any suspicious group or activity, please report immediately to the email mentioned on your screen now. For your safety, we've added links to all our official and verified handles in the description below. Okay, let's now talk about the first emerging high growth industry. Contract research, development, and manufacturing is a fast growing industry within the pharma sector. It includes CRO or contract research organizations, CDMOs or contract development and manufacturing organizations, and CRDMO or contract research development and manufacturing organizations. A CRO engages in early stage research and development for its clients. A CDMO develops and manufactures drugs for its clients. And a CRDMO combines the two types. It engages both in early and late stage development and manufacturing. Now, the contract research, development, and manufacturing model is similar to how the IT industry works. As IT companies handle the technology function for their clients, CROs, CDMOs, and CRDMOs manage drug development and manufacturing for both foreign and domestic pharmaceutical and biotech companies. This reduces their clients to reduce cost, improve scalability, and expedite the launch of new drugs. Now, according to a recent report, the Indian CRDMO market currently accounts for 2 to 3% of the $145 billion global CRDMO market. It has grown at a healthy rate of 15% per annum between 2019 and 2024, and it's further expected to grow by $20 to $25 billion by 2035. Now, as far as the key companies in this space are concerned, an indicative list is on your screen, along with their 3-year sales and profit growth and 3-year average EBITDA margins. Now, in terms of sales growth, companies such as Aarti Pharma Labs, Concord Biotech, Newland Labs, and Sai Life Sciences stand out, with growth rates of over 15% per annum. Aarti Pharma Labs, Concord Biotech, Jubilant Pharm Nova, Newland Labs, and Sai Life Sciences fare well on profit growth. Now, while it comes to EBITDA margins, most of these companies enjoy high margins, with Aarti Pharma Labs, Cohance Concord, Divi's, Laurus, Newland, Sai, and Synergene being at the forefront. Now, many of the companies trade at rich valuations in terms of their PE ratio, but a few like Aarti Pharma Labs, Ecums, and Jubilant Pharm Nova appear to be comparatively cheaper. Now, over the last year, Aarti Pharma Labs, Dishman Carbogen, and Laurus Labs have performed quite well, but Ecums, Cohance, Concord, and Piramal have disappointed. Okay, so what are the things you should keep in mind when you invest in this space? First, keep a tab on the regulatory and compliance risks. Like other pharma companies, CROs, CDMOs, and CRDMOs also have to comply with client and country-specific regulations. Any lapses on this front can have dire consequences. 2. Since this space is capital intensive, keep an eye on the debt levels and capex. Third, be cautious of the concentration risk. If the contract firm has just a couple of big clients, it is vulnerable to losing a large part of its revenue if even one of them switches its vendor. Fourth, patent expiry on the drug can hit both the client and the contractor engaged in its production. Fifth, The revenues and profit of contract firms can be quite lumpy given the nature of the business. Okay, now this brings us to the next emerging industry. But before that, here is something important. You can now get cash to enjoy your present while staying invested for your future with loans against mutual funds on the ET Money app. The interest rate is just 10.75% per annum and there is no fixed EMI. Pay interest monthly and repay the principal amount whenever it is convenient to you. Plus, there is no need for a CIBIL score. So go ahead, check your eligible limit on the ET Money app. The second emerging, fast-growing industry you need to keep an eye on is electronic manufacturing services or EMS. Now, EMS companies handle design, manufacturing, testing, distribution, and repair services of electronic products for their clients. So, in essence, they also work on the outsourcing model. For example, you may have heard of Foxconn of Taiwan. Foxconn handles manufacturing for Google, Apple, Microsoft, Sony, Cisco, and many others. Now, according to Blue Weave Consulting, the Indian EMS market was estimated to be worth $61.9 billion in 2024. It is expected to reach $348 billion by 2031, thus growing by 28% per annum. Now, a host of factors are responsible for this rapid growth, including rising disposable income, rapid urbanization, greater use of electronic devices, availability of financing options, etc. Now, if you take a look at the EMS options in the listed space, quite a few companies make the cut. The growth tailwind in the EMS space clearly reflects in the company's sale and profit growth. Most companies have handsome sales and profit growth figures that are as high as 64% per annum and 98% per annum. The company's margin profiles vary significantly. On the one hand is Dixon Technologies with a 3-year average EBITDA margin of 4%. On the other hand, there is Keynes with 18%. Now, as far as valuations in terms of PE ratio are concerned, most companies have high multiples in absolute terms. At 33 times, Alien's PE is the lowest in the pack. Now, over the last 1 year, the company's stock performance has been mixed, with Amber, Avalon, Centum, Keynes, and Sirima have done quite well. CNDLM, Dixon, Elin, EPAC, and PG Electroplast have disappointed. Finally, let's see what you should keep in mind while investing in the EMS space. First is high competition. The EMS space is highly competitive and this can affect the margins of the incumbents. Second is concentration risk, as we saw in case of CROs, CDMOs, and CRDMOs. The third risk is related to supply chain disruptions caused by geopolitical tensions and trade barriers. Fourth is the risk of change in technology, which can severely affect the business of an EMS vendor. Fifth is the cyclicality and seasonality in client businesses, which can indirectly affect their EMS vendors. So, this was about the EMS space. Let's now take a look at the third and the last emerging industry. With the rise of AI, data centers have come into focus. A data center is a physical space that houses servers, storage systems, networking equipment, and telecom infrastructure. Now, apart from these, a data center also has supportive infrastructure such as backup power supplies, cooling systems, security devices, etc. A data center thus enables storing, managing, and processing large amounts of data. Now, apart from AI, data centers are crucial for other emerging technologies such as cloud computing, 5G and communication networks, blockchain, virtual reality, data analytics, Internet of Things or IoT, cybersecurity, quantum computing, and so on. As such, without data centers, one can't imagine today's advanced technologies to work. Now, according to Anurag, a property consultant, India's data center capacity stood at 1.4 gigawatts in 2024. Another 617 megawatts is expected to be added in 2025, taking the total to over 2 gigawatts. By 2027, this capacity should reach 2.6 gigawatts. Still, the data center capacity remains quite underpenetrated in India. Now, within the listed space, network technologies and E2E networks are two pure-play data center stocks. RailTel also operates data centers, but it caters primarily to government and PSU clients. Now, all these three companies have high sales growth numbers, and NetWeb and E2E have done well in terms of profit growth too. Their EBITDA margins are decent too, but at 62%, E2E's average EBITDA margin stands out. Both E2E and NetWeb have very high PE multiples in absolute terms, but RailTel's PE multiple is quite lower. Now, in terms of returns, NetWeb has pleased investors over the last 1 year, but E2E and RailTel have failed to impress. Among the more diversified players that also have data centers or related operations are Orion Pro, Blackbox, Orient Technologies, and Techno Electric. Anant Raj is a prominent real estate developer engaged in the data center space. Bharti Airtel and Tata Communications are two telecom companies that operate data centers too as part of their wider operations. Okay, now let's take a look at the key risk factors in the data center space. First, establishing a data center can be quite capital intensive. That means large upfront investments that can entail taking a debt. 2. A rapid change in technology can put additional pressure on data centers to upgrade. Third, data centers are energy guzzlers, thus they cause environmental concerns. This can in turn raise their operating cost. Fourth, since data centers are critical infrastructure, they are vulnerable to security risk and cyber attacks. Fifth, Indian data centers face competition from likes of Amazon, Microsoft and Google, which have deeper pockets, greater resources and better technology prowess at disposal. Okay, now let's conclude this video with a general framework for investing in high growth industries. In this video, we talked about 3 growth industries: CRO, CDMO, CRDMO, EMS and data centers. Surely, these aren't the only 3 and there can be many more options. So what can be a general framework for investing in such companies? First, while it's tempting to write on the inherent growth in industry, don't overlook the risks. In this video, while we have discussed the opportunity, we have also discussed the risk involved. Second, high growth attracts more players and thus often results in high competition. High competition erodes margins and profitability. So look for companies that have sort of a moat around them or that enjoy some sort of advantage over peers. Third, high growth often results in high valuations. As a prudent investor, avoid overpaying. It's better to take exposure to high growth sectors amid market downturns or periods of temporary setbacks to such industries that don't destroy their long-term picture. You can consider the relatively cheaper players in the industry. Fourth, diversify. Diversifying your growth portfolio across industries can reduce the damage caused by an error of estimation or from catching the peak or from an unforeseen adverse event. Fifth, understand that no industry remains in the growth phase forever. So keep a tab on industry dynamics and rotate your portfolio accordingly. And with this, I've come to the end of this video. I hope you found it useful, and if you did, please don't forget to share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.